Hello and welcome to Money, Money, Money. I'm Sumaira Abdi and let me start off by wishing you a very happy Diwali. And this Diwali, we want to actually talk about what's happening all around us. So here's what we know so far. There was a global pandemic, which has put the brakes on life as we knew it. There were adverse reactions on pretty much everything, right? So global supply chains went into a tizzy. Demand was naturally affected as well. Work from home became a real thing. Markets have seesawed through these last 2 years. But a lot of us, retail investors, have just taken for granted all that we've been told about how the macros work, what is the relationship between them, and how they've affected our investments. So this Diwali, let's take a step back and understand the very fabric of our investment decisions, the relationship between the global moving parts and how they affect people like you and me. Joining in is Kirtan Shah, founder of Credence Wealth Management. Hi Kirtan, thanks very much for joining in and thanks for making the trip to our studio.
Sumaira, thank you so much for having me on the show.
And this is a very interesting topic because I myself am very keen to understand how everything comes together, right? So first, what has been the story so far?
So Sumaira, like all of us know, and you started off, there was a pandemic. Typically what happened was post the pandemic, everything came to a standstill, right? Now as a central bank, you see that everything is going south or probably not moving at all, right? How do you induce activity in the economy? So I don't think central banks have a lot of other weapons to really play the right card. So you will see them doing this every time you see a similar problem, right? Is where they will try and infuse liquidity in the system. So whenever the economy comes to a standstill, the only weapon largely that central banks globally would have is infuse more liquidity in the system. Now, how do they do that? They do two things, right? First, they will try and reduce interest rates as much as possible, right? Is because what would then happen is if the loan is available to you at a lower cost, it will probably propel you to take the loan and buy or consume the product. By that, economic activity in the economy might go up, right? At the same time, as a conglomerate or a larger organization, when the rates are low, it probably again helps you borrow from the market at a lower cost and keep continuing the capex or various other activities, thereby reducing job loss opportunities and stuff, right? So the first thing that all central banks will do in all global or major problems is try and reduce interest rates. And that is what all central banks did, right? The other thing that they will try and do is try and infuse liquidity in the system. Now, the simpler way of looking at liquidity is like how the Western countries did, right? They actually gave money to you in your bank accounts because you probably could not step out of your house to do that job, right? And the other way to infuse liquidity in the system at large is whereby what central banks do is they buy back bonds from the market, right? So in the past, they would have sold bonds, right, to raise money from the market. What they would now do is go back to the same bank, tell them that I want my bonds back, take this money, right? Thereby buying a lot of bonds from the market and giving a lot of money to the banks and the ecosystem at large, whereby infusing a lot of liquidity in the market. What that liquidity typically does is if a bank has a lot of money available, then they would then want to reduce interest rates even further and still go lending slightly more, right? So what the central banks did was copy paste of what you would have otherwise imagined them do. Reduce interest rates or infuse liquidity in the market, which we call as quantitative easing, right? And that is what we saw happen. And because of that, what happened was very simple, right? Because interest rates were close to zero, right? Would you want to then invest in fixed income? The answer is no, you would not make any returns. Now you got so much of liquidity, right? But you could not do a fixed income instrument because the interest rates were low. Where would that money go? So that money started chasing equities, that money started chasing commodities, and which is why at the start of the pandemic, you saw equity go up after the fall and you saw commodities go up because that money could not chase fixed income because the returns were close to zero. So yeah, this is how I...
So that is how the 2 years have been. Okay, but where do things stand now?
So Sumaira, now what's happening is, and again, copy-paste economics is when you infuse so much of liquidity in the system and you reduce interest rates so close to zero, right? typically this larger liquidity or this larger money will create demand in the market for which the interest rates were made to go zero. Now, there is so much of demand in the market, it will give rise to inflation, right? If you have more and more money, you would be willing to buy commodities or products at any price, giving rise to inflation, right? So now what we are seeing is a global problem of inflation, right? Where, let's say, in India, we are in a far better situation where we are saying that the upper end of the range where we are comfortable in inflation is 6%, but our inflation is, let's say, close to 7%. But if you see the Western world, right, you see US where they are comfortable doing a 2% inflation, they are at 9%. Or Europe or UK where they are comfortable doing a 2%, they are at 10%.
The gap is just too wide.
Huge. Is because the economy that printed the most money, right, is now facing the larger challenge in terms of inflation. Now, because we didn't print so much, right, we've not blown out of proportion like the way the Western world has, right? So currently the larger situation is twofold. First is, of course, because so much of money was printed and so much of liquidity was given to the market, that has led to something called as demand inflation. That gave rise to so much of demand, right, that inflation went up. But the other problem is supply inflation as well, right? So you saw what's happening to Russia and Ukraine, because of which supply and logistics is a problem. China's no COVID policy, zero tolerance policy also created. So now the problem globally is inflation, but that inflation is twofold because there is a lot of demand-led inflation that has happened, and now there is a lot of supply-led inflation that has also happened. So currently, like you see, globally, everybody is trying to curtail inflation as much as possible, Sumaira.
Yeah, so at one point there was a bottleneck with regards to supply. At one time there was a bottleneck for demand, and now it seems like both bottlenecks have suddenly just opened up.
Absolutely.
Okay, but now, Kirtan, explain to us, because we've seen a lot of action by central banks come through over the last few weeks. So what exactly is happening, and is it significant for me as an investor sitting in India to know what global central banks are doing, and what are they doing anyway?
So look, largely if you're a long-term investor, you might as well stay invested, because over a period of time, all of these smaller nuances that affect the market in the short term probably might not create a larger impact. But I think it's very interesting for you to know how all of these things really impact assets as large, right? So look, the way this works is very simple. When you reduce interest rates, right? So let's say in 2020, when you reduced interest rates and when interest rates are going down, right, you will typically see a lot of money flow to equity. Equity went up. You saw a lot of money flow to gold. Gold went up, right? And because interest rates were going down, you probably were not very keen to do fixed income kind of investing. Today, the situation is completely opposite of that, Sumaira. Now that interest rates are going up, right, it's slightly a challenge for assets, right? Let me talk about equities first, right? Now we've seen what has happened to equity in 2022, and the global situation is not that great. India has definitely outperformed largely, but we are also we've not generated FD or risk-free plus some returns given the risk that we take in equity. Now what happens is very simple. When interest rates are going up, theoretically there are three things that are happening, Sumaira. So the first thing that happens is when rates go up, right, loans become expensive. Now think of it as a layman. If loan becomes expensive, are you going to take more loans? Probably the answer is no. If you're not going to take a lot of loans, are you going to buy the house? Are you going to buy the car? Right? Probably the answer is no. So when interest rate goes up, that demand that actually leads for you and me to buy products or consume theoretically goes down, and hence it's like a non-kicker kind of an event for equities, right? Also, when you look at valuations or the way valuations are done, what you do is you predict that the company is going to make some X amount of money in the future and then discount it at a rate of return to get a value today. When rate goes up, that valuation also goes down, right? So theoretically, if you look at equities, you will generally see that when rates are going up, right, theoretically it has a negative impact on the equities market, right, is because of these two reasons that I spoke to you of. And very specifically, when interest rates are going up, right, let's say you look at the US 2-year today, which is at 4.1, 4.2, right? Now, ask yourself a question that if a fixed income instrument is paying me 4.2 in a developed country like the US, why do you really want to take the risk of investing in equities plus take the currency risk by investing outside of the country? So a lot of this money gets attracted towards fixed income, right? And hence that also is a deterring factor to the equity ecosystem, right? So largely if we talk about equity, the bigger problem are these three that I spoke to you of. And that is where equity is kind of stuck in my opinion.
Okay, Kirtan, we're going to take a very quick break. We have more asset classes to discuss and the relationship between them. But all of that is on the other side. For now, do stay tuned. We'll be right back. Hi, welcome back to Money, Money, Money. Kirtan Shah of Credence Wealth Management is still with us. And today we've been speaking about, the relationship between the global macros and what it does for people like you and me and our investments and portfolios, and why it's important to actually understand this relationship. So, Kirtan, we've spoken about, what's happened so far, what's happening now, and the impact on equity. But there are several other asset classes. So let's talk about bonds then. What has been the impact on bonds and how does it all come together?
So, Sumaira, while we talk about fixed income, first we have to understand the relationship between interest rates and the value of the bond, right? And you would have heard a lot of us say that they are inversely proportional, right? What that means is if interest rates are going up, then any bond which is listed will fall in price, right? So let's say if today I issue a bond which is at 8% and issued to you at 100 rupees, if interest rate in the market goes up, right, I will still be making that same 8% and not the higher. Yeah. So my bond will start trading at 95, 90 in the market, and that's how they are inversely proportional. So what happened when the pandemic came was interest rates were slashed, and because interest rates were slashed, that worked out in advantage of the fixed income market. When interest rates went down, the value of those bonds went up. But what's been happening now is you see that globally interest rates are going up, right? You've seen US increase interest rates upward of 3%. India has done almost 190, 200 bips, right? You've seen UK do upwards of 2% interest rate hike, right? So now when interest rates are going up, you saw in 2021 that the fixed income market didn't really do very well because when rates went up, the value of the bond fell, right? And which is why you saw that the longer duration funds, like we call in the mutual fund space, they generated hardly 2-3% return the entire year, and you saw the liquid fund kind of category give you 4.5%. But largely last year, they didn't do anything larger than that. Now what is happening is interest rates are going up. Central banks are trying to do the opposite of quantitative easing, which is quantitative tightening. They are sucking liquidity out of the system. And hence 2021 was not very favorable for fixed income. But now, specifically in the Indian context, Sumaira, I think we are very close to interest rates largely topping out, right? So we probably might have another 35 bips and then a 25 bip kind of rate hike that is expected, largely if things stay where they are, right? So now, while we are talking about fixed income, Sumaira, I think we are at a stage where the interest rates are kind of topping out in the Indian context, and now fixed income will behave slightly differently the way they did in 2021. So probably now is the time where interest rates might top out, and then you might see interest rates falling, and when interest rate starts falling, you would see bonds giving you capital gains, right? So this is probably the time to start focusing a little allocation towards fixed income.
Reviving
which didn't happen in 2021, Sumaira.
Okay, so we've got covered equity and fixed income. What about currency?
So Sumaira, so we've heard while we spoke about other asset classes, currency was the most discussed topic globally in 2021 and 2022. Now, there are 2-3 aspects on currency that I think we should know of, right? First, we said that inflation is going up, right? Now, whenever inflation goes up, your commodity is becoming expensive. So today, if I'm able to buy, let's say, one pen with this 100 rupees, if there is inflation in the...
What pen are you buying? I'm just kidding.
So let's say if the same pen that we are talking about becomes 120, I'm largely saying that the 100 rupee value that it carried prior to the inflation, it does not carry right now, right? So we are saying largely when inflation goes up, your currency depreciates. And we saw that happening globally, right? We saw almost every currency except the Russian currency, if I'm not wrong, every currency is fallen versus the dollar, right? So whenever inflation goes up, your purchasing power goes down and hence your currency would typically
the way we
fall.
like to say, the dollar has strengthened against every currency.
Yes, I very particularly didn't use that term is because there is too much of debate happening whether that's the right way to talk about it or not. But yes, look, largely when inflation...
Either way, that's the impact.
Yes, so largely when inflation goes up, you would see your currency depreciate. That's one. Second, also what happens is, Sumaira, when we spoke about central banks infusing a lot of liquidity, right? Now imagine if you just keep your printing press on and just keep printing the currency and distribute it to the market, your currency is not going to have the same value because there's too much of supply in the market. And this is also what happened because of which currency is depreciated largely globally, right? Of course, India's done a very good job versus global because our macros have been far superior than we spoke about inflation, right? It's not as big a problem as in India versus globally, or we've not printed as much money as the global central banks did, and hence our currency did very well versus the other global currencies. But largely what we are trying to say is whenever there is inflation, whenever there is so much of printing of money happens, your currency will depreciate. But to reiterate what you also made as a point, right? It is not more of what the Indian rupee did versus how strongly the dollar went up, right? So if you look at how dollar performed, right, you look at this index called DXY, which the dollar is mapped against 6 other hard or major currencies. You compare that index's movement versus our, you will understand that rupees hardly depreciated versus the way the other global currencies have depreciated. So we've done a good job. But largely the currency would typically fall in such a situation, Sumaira.
Understood. And it's Diwali, so we can't let you go without talking about gold. How has gold moved? How is gold related to all of these moving parts?
So, Sumaira, gold typically, in my opinion, gets affected because of 2 reasons. First is interest rate, right? Now, imagine a situation where interest rates are high, right? When interest rates are high, you have a very simple option of doing a fixed deposit, right? And why would you want to then try and experiment doing something outside of it, right? So when interest rates are high, money automatically starts flowing towards fixed income. And gold is not a very large preference at that time, right? So currently what is happening is interest rates are going up and hence a lot of money can flow into equity. A lot of money flew into fixed income, but we didn't see a lot of money come into gold, and hence dollar returns, gold was minus 7%, right? The last 1 year that we are talking about, right? The other way of looking at it is dollar. So, Sumaira, internationally, gold trades in dollars, right? So, let's say if $1, 1 ounce of gold is $1, hypothetically, and $1 is 70 rupees, today you buy 1 ounce of gold, you will have to pay 70 local currency, right? But let's say internationally, 1 ounce is $1. Right? But $1 becomes 82, right? That means the landed cost of gold in India from 70 becomes 82, right? So the price of gold goes up, right? In the local currency. Now in this context, if I tell you the last 1 year, gold fell 7% in dollar terms. But in the rupee term, there was 4% appreciation, right? Because the rupee depreciated, right? So gold has a very large impact of where the currency also moves. So if you anticipate that the dollar is going to top out and there is not going to be a lot of depreciation in rupee going further, it might end up supporting the gold prices. Because interest rates have also topped out, and we are saying that probably dollar might also top out and rupee depreciation might not be too strong. I think all of these things will probably support gold going forward, Sumaira.
No, absolutely, because, everybody who says that, over the last 20, 30 years, my gold has appreciated so much, but, had you held dollars in your hand, it would have appreciated just the same. Kirtan, thank you very much for your time today and for making us understand the relationship between the various moving parts that are there globally, which we know as asset classes, and how it impacts our investments. And, just to say that this is a theoretical explanation, but do keep your long-term portfolios mapped to your asset allocation. With that, we'll wind up on this edition of Money, Money, Money. Wish you a very happy Diwali and a prosperous new year.